Hey, good evening, everyone. Marty Mazzora here. It's the 27th of October, 2021. As promised, I am circling back with an updated technical analysis. We'll look at the S&P 500. We'll look again at the dollar. And then I want to follow up on, I believe it was yesterday's blog post, morning note on breadth for the NASDAQ Composite Index. In front of you is the blog post from Monday. And what I did Monday was reminded you that we had this bullish look right here, 2 or 3 weeks ago. It was, I think we ran that on October 5th. So yeah, about 3 weeks ago. And I said this was a really bullish looking short-term setup on the hourly chart, right? We had our falling wedge and we had our nice bullish divergences. And I said, that's unambiguously bullish. Sure enough, we broke out of that, consolidated a bit here, but nothing bearish here. We still had higher lows on the momentum indicators and then continued that trend and broke out above there. And then as I wrote on Monday, maybe not as bearish as this was bullish, but kind of look out in the short term for something not so positive. We basically had an opposite look. We had somewhat of a rising wedge, and then we clearly had negative divergences here. This was falling over right here on the RSI. And, I think we had up days on Monday, did okay on Tuesday. For the most part, we were hanging in there today. Can more vividly illustrate it for you on this screen. This is the 5-minute chart. Here's, finally in here, the S&P really gave up the ghost towards the end of the day. Dow was down a bunch more. Small caps got abused today. And the equal weight index, which really expresses the breadth, was down over 1%. When the technicals were really, really telling us that, odds favored the market, giving something back. And of course, there's headlines to go with all of this stuff. But it is interesting to kind of see and gauge what's happening under the surface, by just really reviewing the technicals and seeing what they're telling us. Get organized here again. Okay, so now we'll look at that right up to the minute. So let me kind of move these colors out of the way so it can easier to look at. So here's that pattern. Breaking below here was a sell signal. Got the big candles here. These divergences played out so far on a short-term basis. Now we've been looking at the 2-hour chart as well. So let me do that for you. So yeah, we really had a nice bullish pattern here on the 2-hour. I think I talked about that on the last video update. And then, here we are. You can definitely call that a rising wedge. Definitely broke down below that. Really rolling over here. So we'll see how this plays out. In the futures market, the market's trying to bounce back a little bit. Asia doesn't look so bad. Typically, Asia, you'll get some good follow through, at least right now. The Aussie market is up. Japan's just kind of flat in the futures market. So we'll see how that plays out. Tomorrow could be a very good day. Again, as I said on the blog, no great conviction here, or as I intimated on the blog. It's earnings season. You get some good news. Google was up a bunch today. I'm not sure where it closed. But, this market can do okay. And we are entering a good time of the year. And as I pointed out yesterday, probably some decent rebalancing, month-end rebalancing for October in these kind of automatic programs. And which means when you're up a bunch in stocks like we are here in October, time to rebalance at the month end. So you could get some selling that last week and some buying of bonds. Bonds had a great day today. There's all kinds of headline news around, what's going on in Washington, what's going on with the yield curve, which no doubt I'll touch on here soon, maybe on this weekend's macro update. And, the threat of hiking interest rates. What the Bank of Canada did today was interesting, what the Central Bank of Brazil as well. So the world is tightening monetary policy. The U.S. is really resisting it. I mean, they're going to taper asset purchases. But I can tell you this, and I can tell you this with a great deal of conviction. The U.S. Central Bank has an absolute obsession with the equity markets, probably as they should, given how bubbly they've allowed them to get, or I should say maybe inspired them to be, or made them themselves. I mean, you can get really cynical and blame it all on the Fed, or credit it all to the Fed if you love this bull market, which how could you not if you're in stocks, right? But the other side of that could get pretty ugly. So we have some concerns that we've expressed a lot herein that we're trying to hedge within our portfolio. Let's go to the daily chart and let me stretch this out. Let's do a 3-year daily chart. Okay, so you absolutely have, a big rising wedge pattern in here with long-term divergences that aren't looking so good, right? So as I said, whether it's this quarter, next quarter, sometime in next year, further into next year, this says that there's probably something notable to the downside, in the works here ultimately, that this market looks really heavy. Now, of course, we could break through this, fix these divergences, and just continue to ride off into the horizon and melt higher. Got to be skeptical with all that's going on in the world, present valuations and so on. And this is just kind of how that sets up. Your rising wedge pattern back here in even the fall of last year. And then you get your 10% sell-offs and so on. The long rising wedge here, back below the COVID hit. Pretty much these kinds of patterns with negative divergences set up, mid-high single, low double-digit corrections to the big ones. And I say this time and again, I don't know that this market's going to roll over anytime soon, but this is probably the pattern that's going to precede it. Okay, so jumping to the dollar, recall that on the last video I showed the rising wedge. I showed the divergences. I said this is, while a lot of people are very bullish the dollar, this makes me short-term bearish. Found support right here at the 50-day moving average. Looking a little better here on the MACD. So we could see the dollar rally a bit here. It's interesting. It held up fairly okay against falling yields today. It was down a little bit, but closed pretty close to the flat line. And as I've just presented here over and over again, a rising dollar on a trend basis is detrimental to asset markets. In our view, no ifs, ands, or buts about it. We are in the declining dollar, longer term camp. We think structurally, fundamentally, we think that's the right thesis. We also know that it's the right thesis from a policymaking standpoint. And that is, all part of that structural inflation narrative that we have going on currently as well. Right now, I would say jury's out in the short term, which way the dollar is going to go. And then lastly, in yesterday morning's note, I pointed to the S&P advanced decline line looking pretty good. So from a breadth standpoint, the S&P 500 overall is looking pretty bullish, right? This has been a good tool for us over all these years. However, to really offset that in a big way, this is the NASDAQ Composites cumulative advanced decline line, breadth reading. So here's the NASDAQ continuing just to meander into, further into all-time high territories with your rising wedge pattern. But here you are with a very stark negative divergence in the breadth. So breadth is rolling over, which means, outside the FANG stocks, I suspect, things don't look so good overall, right? This is not all boats rising with the tide, and that is a very bearish indicator. It's not a sell signal, but it just basically says prepare yourselves, for something not so good. So let me show you what that looks like longer term. This data, we can go all the way back to about 1997. And so what I did here is I captured, most of the double-digit declines, right? So here we were before the real big one, which call it 80%, for the NASDAQ Composite Index. And notice that right in here, breadth was really beginning to decline as the NASDAQ was moving up to all-time highs. And then you can see the thing fell apart. In here, we had an 18% hit, 14% hit. This 30 is annualized, disregard that. 14% hit, 15% hit, 56% hit in 2008. Notice, the breadth, pretty consistently rolling over. You get your moments, where it looks better. And then you had breadth hanging in there just fine. Beginning to roll over here though, rolling over with a 19% decline, rolling over ahead as a warning of a 20% decline in here, continuing to roll over as we came down to 13%. Came out of this fine, began to roll over into a 19% decline. Breadth was just fine right up here, began flattening out and then rolling over along with this 23% decline. If I were to zero in right here, breadth rolled over just a few months before the COVID crisis hit. So breadth was giving us a signal here of something. Had a 13% decline in here. And here we are today, folks, with a pretty dramatic rolling over in breadth, with the market still hanging in there. Does not mean for sure that this is going to roll over and we're going to see a big 20+% decline in the NASDAQ. Kind of what I said before. When that happens, not if, but when that happens, good chance we're going to have readings like this breadth reading preceding that. Doesn't mean that this doesn't come roaring back up as this continues to make new highs. Doesn't mean that at all. What we're looking for are just characteristics of market stress or market risk that confirm that we need to keep hedging certain areas within our portfolio. Be prepared to take advantage of a big dip in the market. But right now, what it says is, do what we're doing. Be well diversified. Use options to hedge against big, gigantic, sell-offs. Keep gold in the portfolio and buy the things, of course, longer term, as I've illustrated over and over again, that do well in a weaker dollar environment. But for the purposes of today, what I'm showing you is that while there are definitely bullish indicators like the S&P advanced decline line, there's what I would call concerning indicators like the NASDAQ advanced decline line. Why would I put so much weight on this? Well, this is where a lot of tech stocks are traded, and tech occupies 27% of the S&P 500 index. And that's the kind of weighting that we have not seen since just before this 80% decline over here. So again, doesn't mean we're going to go crash and burn tomorrow. It just means the next time we do crash and burn, setups are going to look something like this. Thank you, as always, for watching and listening. Talk to you again soon. Bye-bye.